Alright, you might be an advanced investor or even someone who just started investing, but no matter what you do and how much you invested, we all want to hear from Buffett, who compounded a significant amount of wealth through his mistakes and success too. And he's more than a simple investor, he is the mentor of millions of people who showed valuable and essential lessons throughout the past 80 years. And for now, he's literally the most successful investor of all time. Let's talk about his 9 most important tips and lessons he shared since he was 11. Alright, his tip number 1 would be to actually start investing early. Buffett is known for his early approach to investing, so in his teenage years, Buffett had saved up around $5,000 from various jobs and investments. And by the time he finished college, he had around $10,000 in savings, which he directly invested, of course. At 30, he had a net worth of around $1.6 million. It does not seem like that much for a guy like him, right? When we know that he's worth billions of dollars right now. But by his mid-30s, Buffett's worth had grown to around $25 million. In his early 50s, he became a billionaire for the first time, and today, in 2023, he's worth $104 billion at 92. As you can see, he made the majority of his wealth after he turned 50, and this is because of something called compounding. So this is the story of Ronald James Reed, who was a former janitor for pretty much all his life. And he was born in a poor family and got little to no education. But when he died at age 92, he was worth $8 million. And they both don't know each other, right? But they share 2 huge things in common. They both started as early as possible, and they both continuously invested their money for 70 years in the stock market. Alright, so his tip number 2 will be to actually invest in index funds. So we could do like Warren Buffett and actually buy individual companies following his rules, right? But this is really pretty boring and time consuming in the end. Instead, Buffett recommends to actually invest in a basket of companies, like 10, 30 or even 100 companies at the same time. And for example, we have the S&P 500, which is the index that tracks the 500 biggest US companies. They are listed by market capitalization, so the better the company, the higher it will be ranked. So we first have Apple, Microsoft, Amazon, Nvidia, Google, Tesla, etc. And this index alone constantly evolves over time. Stocks have been added, removed, sectors also have been changed. And for the past 100 years, from 1923 to 2023, the S&P 500 increased by around 10.49% a year on average. And that beats the vast majority of investors and inflation too. And it also means that if the S&P 500 loses 50% of its value or more, all of the companies in the US would lose as much, if not more. So actually we cannot directly invest in it, since it groups 500 companies. We can instead invest in an index fund, so a fund that tracks and replicates an index, like the S&P 500. And as teenagers and young adults, we can fully take advantage of this snowball effect. And it will be even better in the next 20 to 30 years. There's just only one drawback to it. Compounding takes time. I mean, a lot of time. You simply cannot expect to double or triple your investment in 1 year alone. Here, your best friend is the S&P 500, of course, since it gives you a high return with really low risk, but your biggest enemy here, of course, is time. So to give you an idea, $1,000 in the S&P 500 for 10 years, which everyone can afford, I think, will give you close to $3,000. In 20 years, that adds up to $8,000. In 30 years, $23,000. And in 40 years, $65,000. And this is even better in 50 to 70 years when you invest a few $100s each month. And this brings us to the tip number 3 from Buffett, which is the number 1 behavior when it comes to investing in the stock market. Investing is in the long term only. And there are a few good reasons to explain this. Well, first, investing in the short term is way more risky because investors like us are competing against traders, which also buy and sell stocks, but only in the short term. So take a look at this. Traders have an investing horizon of between roughly 1 day to 1 year, maybe 2, I would say, and they simply try to go with the trend, but investors have to think in at least 5 to 15 years. So think of it like this. Investing your money is like throwing it away for 5 to 15 years. You have to accept that it can go down as much as it can go up, and you are simply most likely to be right in the long term. That explains why in 1 year Apple looked like this, a random mess which goes up and down every day without a clear directions, right? But for the past 5 years, Apple went significantly up. I'm not really saying that you should put $1,000 in Apple right now, but it shows that investors believe in Apple in the long term, no matter what was happening to the economy. For example, the current inflation rate in the US, at least, is now 6.04% compared to last year. This is huge, right? But when you think about it for a 100 years time frame, things appear to be slightly better than we think they are. Despite decades of crises, wars, and unpredictable events, inflation is on average 2.91% a year for the past 100 years. Alright, before we get to the next part, I have a question for you. What will a penny doubled for 40 days be worth? In other words, on day 1 you have $0.01, on day 2 $0.02, then $0.04, and so on. It is a tricky question, right? Doubling a penny does not seem like that much, right? But at the end of those 40 days, that $0.01 is now worth $5 million. This again is the power of compounding. The growth is almost non-existent in the beginning, right? But then the compound effect kicks in and we start to see a huge difference. Now, replace the first day by the age you started investing. And that is a rough but also a great view of how much you could make in the S&P 500 in the next years. Alright, the tip number 4 would be to actually read a lot of books, because reading is by far the best way to unlock new content and tips from investors who also got experience in the investing world. Reading 10 books only will give you hundreds of years of experience summarized in a few hundred pages only. They will give you the foundation and key idea of how to invest in the stock market, but also what not to do and what to avoid. And most of the time, Google or ChatGPT cannot replace books because they simply contain everything you need to know with the right and most pertinent information. I've made a whole video about it right there if you're interested. So I won't give you any other argument about why are books so cool, but instead I will give you the great books to start and understand investing. So now I think the first one would be Rich Dad Poor Dad by Robert Kiyosaki. In this book, I learned everything about how money works and how to make the most out of it. He also talks about this whole investing versus buying stuff and how to do it. So a pretty great start in my opinion. And we then have The Psychology of Money by Morgan Housel, which is the next step to understand money and how to make the most out of it. I have learned timeless lessons about the stock market and how we should think about money and how to even start investing today. And here are the other books that might be a great pick if you want to learn more about investing and the psychology of investing. Alright, next I would recommend that you read the annual shareholder letters written by Warren Buffett. The first letter was written in 1965 and he didn't ever stop writing them every single year. They always are highly anticipated by investors and his shareholders too, because they contain valuable information on the company's operations, performance, and strategy too. The letters typically include 3 things at least. First, a review of the Berkshire's financial performance for the previous year, then insights into the company's investment philosophy, and also future plans. And finally, Buffett often includes his thoughts on a wide range of topics from the economy, the stock market, to investing principles too. And by the way, the letters are also known for their clarity and accessibility too, because despite dealing with complex financial topics, Buffett writes in a straightforward and engaging style. So that makes his insights accessible to all investors of all levels, from beginners to advanced. Alright, now Buffett gave a really great advice when it comes to this fear versus greed thing. Most average investors, if they see a stock they like that's going up, chances are they will buy the stock. When we see the price of X or Y stock increasing, we are most likely to follow the trend, right? This is the fear of missing out on the trend. We unconsciously think that it will continue to go up or down, or at least continue its trend. And as we've said previously, this is more trading than investing. How do we know what Apple will be worth in 1 month, 1 year, or even 10 years? This is the trickiest part to find, and chances are you will be wrong. For example, what do you think will be the next move here? As always, 3 possibilities: up, down, or sideways. In fact, Apple lost 35% of its value in 1 month. That happened because of the pandemic. Because of the COVID-19, everything got shut down and people got scared and sold. So right at the beginning of 2020, your investments would have lost 35% of their value. This gives us the first most valuable lesson when it comes to investing in Apple or any other stocks. Always think in the long term. Remember that you are most likely to be right in 5 to 10 years than in the next 5 days. And this in fact brings us to the price versus the value. So here are 7 screenshots taken every month from the videos I've made in my series called Invest With Me. It is pretty straightforward, right? Each month we can invest together a few $100s in stocks that I carefully choose. And as you can see, none of them look like the others. Every time something made their price moved up or down. And that is something you can hardly control. I mean, not at all. The price of a stock has nothing to do with its earnings. Or in other words, it is the price versus the value, and not the price equals the value. And once we get that, we will understand at least half of investing. Sometimes the stock will go up because more and more people think that it went up, so they will continue to go up. Or sometimes the company will buy another company, so its price will move again. Or layoffs that are both a good and bad sign for the company and its price. So if there is one thing I learned from the past 6 months, it is that the price you buy does not reflect the real or intrinsic value of the stock. Alright, there is something I wanted to talk about. Warren Buffett is known for picking great individual stocks at a cheap price, right? And most of the time people try to pick the best possible company that will probably go to the sky and beyond. But again, the truth is that no one really knows what is going on in the stock market. The truth is that most investors should be investing in index funds. So knowledge and experience are required, yes, but only to understand why this is the best investment that could be made over the long term. Knowing what to do is as important as knowing what not to do. And yes, Buffett is mastering the individual stock picking for decades now. He did this for almost 80 years, right? Every day reading dozens of annual reports and books and journals to then be able to beat the markets. But for the vast majority of people, he simply recommends to regularly invest in the S&P 500. Now, there is one last thing I wanted to talk about. It is this whole story thing about the S&P versus S&P, which is actually a pretty interesting debate about education. So we have the possibility to invest, let's say, $10,000 in the S&P, which would give us around $1,000 after 1 year. Now, there actually is a better way to use those $10,000 and earn even more money, because investing is simply putting our money to work and have more after it, right? But stocks and shares are only one way to make that happen. We can also buy courses to learn new content and skills and maybe expect a better return on investments on it. Especially if you are young and want to learn more about that new things that might be interesting to you. For example, you could be like me and want to learn more about YouTube, so you would take a YouTube course to learn about videography, storytelling, and how to systemize your workflow, for instance. Alright, if you want to learn more about Warren Buffett, here are his top 5 stocks for 2023. And if you are wondering what you should do between investing Apple or buying Apple, the video is right here. Alright, thank you so much for watching. Feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.